The banking sector in India plays a crucial role in the economy. This presentation will delve into its structure, the reforms it has undergone, and the challenges it faces. A bank is a financial institution that accepts deposits, lends money, and provides various financial services. In India, banks are vital for economic growth, offering services to individuals and businesses alike. The structure of the banking sector in India includes scheduled commercial banks, cooperative banks, non-banking financial companies, NBFCs, and all India financial institutions. Let's discuss about each a bit. 1. Scheduled Commercial Banks, SCBs, definition. These are banks listed under the Reserve Bank of India, RBI, Act and include public sector banks, private sector banks, foreign banks, and regional rural banks, RRBs. Functions. Offer basic banking services like deposits, loans, and financial services. They play a significant role in the monetary policy framework. Regulation. Regulated by the RBI and must maintain a minimum capital requirement and follow strict guidelines, including cash reserve ratio, CRR, and statutory liquidity ratio, SLR. Examples. State Bank of India, SBI, HDFC Bank, a CC Bank. 2. Cooperative banks definition. These are financial institutions formed under the Cooperative Societies Act and primarily cater to the rural and agricultural sector. They are member-owned institutions. Functions. Serve members of a cooperative society and provide similar services to commercial banks, focusing mainly on small borrowers, agriculture, and rural banking. Regulation. Regulated by both RBI, for banking-related operations, and state governments, for registration and administration. Examples. District cooperative banks, urban cooperative banks. 3. Non-banking financial companies, NBFCs, definition. These are financial institutions that provide banking services without holding a banking license. They are not allowed to accept demand deposits from the public. Functions. Focus on providing loans, asset finance, leasing, and other financial products, especially for sectors that might not have easy access to traditional banks. NBFCs cannot issue checks drawn on themselves. Regulation. Regulated by the RBI but under lighter regulations than banks. They follow different reserve requirements. Examples. Bajaj Finance, Mahindra Finance, HDB Financial Services. 4. All India Financial Institutions, AIFIs, definition. These are specialized institutions established by the government for specific purposes to support industrial and economic growth across the country. Functions. Provide long-term finance and support development projects across sectors like infrastructure, agriculture, export-import, and industrial finance. Regulation. Supervised by RBI and other regulatory bodies, though with a specific focus on developmental and promotional functions. Examples. National Bank for Agriculture and Rural Development, NABARD, Export-Import Bank of India, Exim Bank, and Small Industries Development Bank of India, SIDBI. Several reforms have shaped the Indian banking sector. The Narasimham Committee in 1991 recommended reducing government interference and enhancing RBI supervision. Objective: to address the inefficiencies in the Indian banking system and to lay the foundation for financial sector reforms. Key recommendations: reduction in SLR and CRR, lowering the statutory liquidity ratio, SLR, from 38.5% to 25% in the cash reserve ratio, CRR, from 15% to 35% to improve bank liquidity. The Raghuram Rajan Committee in 2008 focused on reducing government stakes in public sector banks and improving corporate governance. Objective: to examine the financial sector reforms in India and to suggest measures to strengthen the banking system, enhance financial inclusion, and promote financial stability. Key recommendations: financial inclusion, promoting access to financial services for all sections of society, especially the underprivileged. Strengthening financial institutions, enhancing the role of financial institutions like the Securities and Exchange Board of India, SEBI, and the Insurance Regulatory and Development Authority, IRDA. Additionally, the Basel norms were adopted to improve the stability of banks. The banking sector faces several challenges, including non-performing assets, NPAs, the need for technological upgrades, regulatory compliance, and economic uncertainties. Persistent NPAs lower investor confidence, affecting the valuation of banks and their ability to raise funds. Adopting advanced technologies like AI, blockchain, and digital banking solutions demands significant investment, which constrain resources, especially for smaller banks. Evolving regulations and guidelines from the Reserve Bank of India, RBI, and other authorities require continuous adaptation, often involving compliance costs and operational adjustments. Banks are essential for financial inclusion, economic growth, and implementing monetary policy. They help bring unbanked populations into the formal financial system, stimulate economic activity, and control inflation. The total banking sector assets in India have shown significant growth over the years, with projections indicating continued expansion. The graph illustrates the trend of total banking sector assets in India, in billion USD, over 4 years, 2021 to 2024. The assets are categorized by the contribution of public sector banks, private sector banks, and foreign banks, with a total asset figure shown on the right-hand scale, RHS. Here's a detailed breakdown. 1. Yearly trends 2021. Public sector, $1,471.80 billion United States dollars. Private sector, $805.84 billion United States dollars. Foreign banks, $158.75 billion United States dollars. Total assets, $2,436.39 billion United States dollars. 2022. Public sector, $1,529.70 billion United States dollars. Increase. Private sector, $822.37 billion United States dollars. Slight increase. Foreign banks, $179.35 billion United States dollars. Increase. Total assets, $2,536.42 billion United States dollars. 2023. Public sector, $1,686.70 billion United States dollars. Significant increase. Private sector, $1,016.39 billion United States dollars. Sharp increase. Foreign banks, $189 billion United States dollars. Moderate increase. Total assets, $2,892.09 billion United States dollars. 2024 projection. Public sector, $1,681.72 billion United States dollars. Slight decline. Private sector, $1,264.28 billion United States dollars. Increase. Foreign banks, no significant change. Total assets, $2,946 billion USD. 2. Key observations. Public sector banks witnessed consistent growth until 2023, followed by a minor decline in 2024. Private sector banks, steady growth, with a notable spike in 2023 and projected continued growth in 2024. Foreign banks, gradual and minimal growth across the years. 3. Possible reasons for fluctuations. 2022 growth, moderate increase, economic recovery post-COVID-19, increased credit demand, and supportive fiscal policies likely contributed to asset growth in all sectors. 2023 growth, sharp increase. Private sector saw rapid expansion due to higher retail lending, digital transformation, and penetration into underserved areas. Public sector benefited from policy-driven capital infusion and infrastructure projects. Foreign banks increased marginally as they focused on niche services like corporate banking and wealth management. 2024 decline in public sector. Slight decline could be attributed to tightening of fiscal support, higher non-performing assets, NPAs, or competition from private banks. Private sector's continued growth might indicate diversification, better financial management, and digital adaptation. The Indian banking sector comprises public sector banks, private sector banks, foreign banks, and regional rural banks. Each category plays a unique role in the financial ecosystem. The image is a bar graph titled Interest Income Growth, US dollar billion, and shows the interest income growth for the public sector, private sector, and foreign banks from 2021 to 2024. The graph uses 3 different colors to represent each sector: blue for the public sector, orange for the private sector, and yellow for foreign banks. Explanation of the graph. 1. Public sector, 2021 to 2022, increased from $88.7 billion to $101.6 billion. This could be attributed to higher interest rates and increased lending activities. 2022 to 2023, slight increase to $102.4 billion, possibly due to stable economic conditions and continued growth in lending. 2023 to 2024, significant increase to $128.1 billion, likely driven by robust economic policies and higher interest income from loans. 2. Private sector, 2021 to 2022, increase from $56.64 billion to $63.60 billion, reflecting a growth in credit demand and higher interest rates. 2022 to 2023, further increased to $70 billion, possibly due to stronger economic performance and increased borrowing by businesses and consumers. 2023 to 2024, sharp increase to $95.7 billion, indicating substantial growth in lending and higher interest earnings. 3. Foreign banks, 2021 to 2022, decrease from $8.36 billion to $7.90 billion, which could be due to changes in foreign investment policies or economic conditions in countries where these banks operate. 2022 to 2023, increased to $10 billion, possibly due to improved economic conditions and better performance of foreign investments. 2023 to 2024, sharp drop to $0 billion, which could be due to regulatory changes, withdrawal from the market, or economic challenges affecting foreign banks' operations. The fluctuations in interest income growth across these sectors highlight the dynamic nature of the banking environment and how various factors, such as economic policies, interest rates, and market conditions, influence the financial performance of banks. There has been consistent growth in deposits and bank credit over the years, reflecting the increasing trust and reliance on the banking sector. Reasons for changes in deposits: economic conditions. Stronger economic growth typically leads to increased deposits as people and businesses have more surplus income to save. Interest rates. Higher interest rates can encourage more deposits as savers seek better returns on their money. Government schemes. Initiatives like the Pradhan Mantri Jan Dhan Yojana, PMJDY, have increased financial inclusion, leading to more deposits. Trust in banking sector. Improved confidence in the banking system can result in higher deposit levels. Reasons for changes in bank credit. Economic growth. During periods of economic expansion, demand for credit typically increases as businesses seek funds for expansion and consumers for spending. Interest rates. Lower interest rates can lead to higher demand for loans as borrowing becomes cheaper. Regulatory changes. Policies and regulations affecting credit availability, such as the introduction of new banking norms or changes in lending criteria. Market conditions. Economic downturns or financial crises can reduce the demand for credit as businesses and consumers become more risk-averse. Key observations: the significant increase in deposits in FY20 and FY21 could be attributed to economic uncertainty during the COVID-19 pandemic, leading individuals and businesses to save more. The decrease in bank credit in FY18 might be due to stricter lending norms following the high levels of non-performing assets, NPAs, in previous years. The sharp increase in bank credit in FY23 suggests a robust economic recovery or increased lending activities post-pandemic.